Zero net cost loans. In this episode, I'm going to address IUL fixed loans. How do they work? You're going to be blown away when I teach you how powerful this is, because many financial advisors do not understand this concept. So my name's Doug Andrew, and I've been a retirement planning specialist, a financial strategist for more than 45 years. And I've helped many thousands of people optimize their financial assets and minimize taxes and empower what I call their authentic wealth. As people prepare for retirement, whether they have 5 years, 10 years, 30 years, 40 years, one of my favorite vehicles to help them accumulate their money tax-free, not just tax-deferred, and be able to access the money tax-free during retirement and not outlive their money. And when they ultimately do pass away, it blossoms in value, increases in value, and transfers tax-free, is what I call the Laser Fund. And at the end of this episode, I'm going to gift you a free copy of my most recent 300-page best-selling book called The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement. But when people begin to read and study about an IUL, IUL stands for Indexed Universal Life. And this turns into a tax-free cash cow when you maximum fund it. Basically, this was the brainchild of E.F. Hutton back in 1980, and they were not an insurance company. They realized in the Internal Revenue Code under 3 sections, Section 72E, 7702, and 101A, the permanent life insurance policies were the only instruments that allowed you to accumulate your money tax-free, be able to take out money tax-free, and when you die, it blossomed and transferred tax-free under those 3 sections of the code. But way back in the 1960s and 70s, my heavens, the only insurance were whole life and term. And whole life generally would only maybe credit 3.5–4% at the best. Well, E.F. Hutton changed all that because they said, what are we thinking? Instead of using life insurance for death, let's use it for a living benefit. Let's turn it into tax-free accumulation and tax-free income. Let's take the least amount of insurance the IRS will let us get away with. And let's put in the most money, the most premium the IRS allows, as fast as they allow, and it turns into a tax-free cash cow. Basically, you can put in $500 a month, take the least amount of insurance, and $500 a month will grow at an average return of about 9.6% is what I've averaged for the last 4.5 decades. It will grow to $1 million tax-free. Or I've had many clients who just throw in $500,000 and it doubles to $1 million about every 7.5 years. Do the math. $500,000 goes to $1 million in 7.5. In 15 years, $1 million doubles to $2 million. Another 7.5 years, it doubles to $4 million to $8 million. I have people who started out with $500,000 in max-funded indexed universal life insurance. That $500,000 is now worth $8 million, generating 10% or about $800,000 a year. They don't even need that much. They're living on $300,000 a year of tax-free income. Why is it tax-free? I'll share with you why it is. Now, in the book I'm going to gift you at the end of this episode, you'll learn that there's 3 ways to access money out of a max-funded universal life insurance contract. The sad way, the dumb way, and the smart way. Now, the sad way is one heck of a return, but I wouldn't recommend that one. That's by dying. That's for death benefit, and that's always been tax-free. And you put in $500 and you die the next day in an accident, they're going to pay you $1 million, okay? That's one heck of a return, but I wouldn't recommend that option. But sometimes people do die prematurely. But that's tax-free because the government says you're helping out the government by not having the government have to take care of widows and orphans. So we're not going to tax those. Those are tax-free. But see, people began to use it for living benefits. So the money that grows inside of an insurance contract is totally income tax free because you're taking pressure off of the government to take care of you in retirement because a lot of people will outlive their money. And so they have to rely on government welfare or whatever. And Social Security is not going to cut it. So they say, let the money grow tax-free. And if you want to use it for retirement income, for living benefits, it'll be tax-free. Those are under sections 7702 and 72E. It grows tax-free, you take it out tax-free. The dumb way to take out money is to pull out the money in the form of a withdrawal, okay? Because you will recover your basis. It's taxed FIFO, first in, first out. If I put in $500,000 and it grows to $1 million, okay, and then it's earning 10%, I can pull out $100,000 a year. The first $500,000 I pull out, the first 5 years I pull out $100,000 a year, that's tax-free because the first money I put in is the first money out. There's very few financial instruments in the Internal Revenue Code that are taxed FIFO. But that means after you've recovered your basis, your $500,000, that's dumb to call it a withdrawal because now you trigger tax. You have to pay tax. No, the IRS said, no, that's not smart. The smart way is to change the nomenclature. Just change how you're terming the withdrawal. Don't call it a withdrawal. Call it a loan. They're the ones who tell you to call it a loan. Why? Because loan proceeds are smart because they're not taxed. When you go borrow money from a bank for a house or anything, a car, you don't have to pay tax on what you borrow. Loan proceeds are not taxable. So the IRS says, oh, just change the nomenclature to a loan. You're not withdrawing your money, now you're borrowing money. Now, the first thing people say is, borrow? Why would you borrow your own money? Quit looking. Look at what it does. Are you ready? Ever since 1986 tax reform, there are 3 types of income that Americans pay income tax on. Earned income, that's wages and salaries. Passive income, rents or leases. Portfolio income, that would be interest or dividends. If you have income in retirement that is not one of those 3 types of income, there is nowhere on a tax return to put it. It's not a tax loophole. The IRS knows you're receiving that money, but it's tax-free. It's that cut and dried. Loan proceeds are not earned passive or portfolio income. They're tax-free. They always have been. So how does this work? Why would you borrow your own money? To have tax-free income for the rest of your life. Let's do the math. Now, if this is intriguing you, and you can think of somebody that ought to watch this episode, be sure and share, click like, post a comment, but subscribe to this channel because I post an in-depth answer to a financial question almost on a daily basis. And this is not about me. This is about you and those that you care about. So let me explain this. I've already established that the IRS says if you will call it a loan, it's tax-free, okay? So let's just say you have $1 million accumulated and take this snapshot in time and it's earning 10% because I've been earning an average of 9.6, 10, 10.07% for years. So it's simple math. If I have $1 million in my insurance policy and it's earning 10%, I can withdraw $100,000, but after I've recovered my basis, now I have to pay tax on that $100,000. I might only net $70,000 after tax. That's dumb. If I borrow $100,000, there's not a financial institution I'm aware of, a bank or credit union, that if you have $1 million sitting in there, they'll loan you $100,000, the equivalent of the interest that you would be earning. The sad thing is banks and credit unions don't pay a 10%, but insurance companies with indexed universal life do. So let's say you have $1 million of cash value in your insurance policy, and it's earning 10% because that is what I've earned on the average for many 25-year period that I looked at for the last 40 years, okay? Now, that's $100,000. If I pull out $100,000 and withdraw it after I've recovered my basis, I just triggered tax every year on $100,000. I may only net $70,000 to buy gas and groceries. Why do that? So I go to the institution and I say, can I borrow $100,000, which is the equivalent of the interest you're crediting me this year? Sure. The interest that I'm earning is the collateral to borrow $100,000. So on the ledger, here's my million, and I'm borrowing $100,000, and they're crediting me interest on my million, right? Okay. Now, the collateral is there because I'm borrowing, changing the nomenclature instead of withdrawing the money, and now the $100,000 is tax-free because it's a loan proceed. All the insurance company is required to do is keep a loan balance. So on the loan balance, I pull out $100,000 a year. So it's 100, 200, 300, 400,000. But my cash value is growing by 100,000, 200,000, 300,000. Pretty soon, let's say 10 years down the road, I've pulled out $1 million, but my cash value is now worth $2 million. $2 million of cash value minus the $1 million of loans is the same net $1 million I would have had I pulled it out the dumb way and paid tax every year for 10 years. That would have been $300,000 of unnecessary tax. Now, the insurance company has to charge a nominal interest rate. So that varies with insurance companies, but it's usually around 2.25%, 3%. Let's say 2.25%. So the insurance company, if you borrow $100,000, they have to charge you 2.25%. So that'd be $2,250, right? So they charge you $2,250. But over here on the $100,000 of collateral that collateralized that $100,000 loan, they will credit you the exact same rate or within 0.25%. Most of the time they credit you 2.25% here. So they're crediting you $2,250. They're charging you $2,250. It's a zero net wash. That compounds through the years. This is growing compounded at 2.25%. This is being charged at 2.25%. At the end of the day, this loan is not due and payable during your lifetime. When you die, it's washed away because this is growing, and this minus this liability is the same amount of money you would have had you pulled it out the dumb way and paid tax the rest of your life. Sounds simple because it is. That's called a zero cost or zero wash loan because the IRS says just change the nomenclature. What you call it, it's a loan. Okay? It's a loan. It's tax-free. This is not a loophole. That's called a zero cost or a fixed loan. Some companies, they could charge a higher rate, maybe they cap it out at 7 or 8, but usually the spread, if they even have a spread in the first 5 years or so, they might charge 2.25% and credit you 2. It's 0.25%. Would you borrow money at 0.25% interest? I would all day long. This is the magic behind what are called fixed loans. But I want you to watch the episode that talks about variable loans because you're going to be blown away, where you can pay a lower rate and keep earning a much higher rate on all of your cash value. That's what I do. That's what smart people do. If you have heard enough and you want to learn more, I'd like to gift you a free copy of my most recent best-selling book. It's called The Laser Fund. It's actually 2 books in one. This one is 200 pages, 14 chapters with all the charts and graphs, and it shows you these loans with charts. Now, if you're not into numbers and you want to see how it works in real life and you learn more by your right brain, you flip the book over and read this one. This is 12 chapters, 100 pages with actually 62 client stories, and you will see how it works in real life. If you want to use your whole brain, read both. It's 300 pages of information that are game changers for people so they don't outlive their money. So go to laserfund.com. Click below, laserfund.com. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll fire out a free copy of this book for you. And you can begin to become enlightened on how you can manage your money better and not outlive your money and have tax-free income for as long as you live.